Hello, welcome back to another video. In this video, I will be going over some stocks that I have on my watch list, some stocks I'm also looking and monitoring for their earnings reports. There's some stocks I'm going to point out here, and I'll say that I'm not monitoring them at all and I'm not interested to buying them. Now, if you want me to go into detail, write in the comments and I can go into detail why exactly this business. For Monday, Ryanair, I'm not monitoring. I mean, all of those left companies on the left, and Monday, I'm not monitoring at all. United Health Group will be fun to monitor, but I'm not looking to buy at all. Boeing, I'm not looking to buy. UPS will be also fun to monitor, but I'm not looking to buy. GM, I'm not looking to buy. And American Airlines, I'm not looking to buy this at all, actually. Texas Instruments is a good company. It's very interesting, I would say, and I would monitor this. Will I buy? I don't know, but I will definitely monitor this. And everything else here, I don't really care about. Wednesday is going to be a big day. ASML, I'm definitely monitoring ASML, and I will be talking about it in this video. ASML would be very important to monitor for this quarter, I would say, because it would tell us how the tech companies are spending and whether spending is decreasing. GEV is a good company, but not my style, so I would not be monitoring this. Starbucks, not monitoring it, and everything else here I'm not monitoring. Microsoft, I'm definitely monitoring Microsoft, and Microsoft is in the list on this video. Meta as well, of course, one of the biggest, I think it's the biggest holding right now in my portfolio. Tesla, Tesla's Tesla. What else can I say? I don't think they're going to deliver. I think it's not going to be a good quarter. But yeah, Lam Research, it's a good company. It's a simple company. It's very crucial for the semiconductor. I will be monitoring Lam Research. ServiceNow is a good company. I think around 80 to 85% of the S&P 500 companies use it. ServiceNow is very important to monitor because it would tell us the shape of the software companies. If ServiceNow is growing and they're not looking bad, their financials are not looking bad, then it could also hint that the software companies are not losing and AI is not replacing them. So ServiceNow, I think, would be very important for the software companies. Waste Management is a good company at a fair price. Will we get a fair price? Will it go down? We'll see. Mastercard is very important. I think Mastercard is one of the amazing businesses in the world. I do have it in this video, one of the companies that we'll be going over today. And Mastercard is always a threat. Mastercard always seems like it's a threat. Mastercard always seems it as threat, and that the government is trying to decrease their duopoly with Visa. I picked Mastercard. It's not because Visa's bad. Visa's more stable, I would say. Mastercard has more growth in it, more international exposure. The financial side of the market does have some competitors, I agree. The problem with Mastercard, I would say, is the 2% fees that they charge. A lot of restaurants and small companies, even big companies, do not like it. I mean, if you think about it, Amazon has low margins. 2% really doesn't matter for Amazon and other companies as well. So the 2% is the problem that customers have. As a shareholder, I don't have this problem. More money for Mastercard. And what I like about Mastercard is that it really, I would say, it's a hedge against inflation and bad economy as well. I mean, if there's inflation, prices are up, your Starbucks coffee is $8 or something, then that's more money for Mastercard because the ticket size go up, so it's more money. So I think Mastercard is a very good company to have in your portfolio. Not financial advice. Nothing here is financial advice. Good to have in your portfolio. It's a hedge against inflation, and it would be interesting to monitor. I would pick Mastercard over Visa, but I think they're both equally the same. I would even sometimes pick both in my portfolio, but because I run a concentrated portfolio, so I only chose Mastercard. But if I wasn't, I would pick both. Caterpillar is also good to monitor. I don't know if I'll be monitoring, but it's an interesting company, I would say. Nokia, they shot up in price a few weeks ago for the deal they made, and I don't know. I'm not going to be monitoring Nokia. Everything else here, I'm not going to monitor. Lockheed Martin, I'll be looking at, but I'm not looking to buy this company. Apple would be an interesting company to look at. I mean, it's interesting to see their sales in December and leading up to the holidays. Apple, it's very weird that the company is still in the Magnificent Seven. You can say the ecosystem lock-in really does make them that big of a company, I would say. But their revenues are not, as in iPhone sales, they're not growing as much. That's why their software side is growing. That's where they're coming up with solutions. Apple Creative Studio, I just covered this in a video I had, which kind of indirectly competes with Adobe, but directly competes with CapCut and Canva, I would say. SanDisk is also interesting to monitor. I don't think I'm buying it, but it's interesting to monitor with the memory side. A lot of memory stocks are going up. Visa is also interesting. I mean, everything I said in Mastercard here, it also applies to Visa. And everything else here, I will not be monitoring. Friday, you have SoFi, big name. I'm not an investor for SoFi, but it's a big name. I will likely not monitor. I won't read any of the reports or anything. Just look if they beat earnings or not. American Express also kind of fills in with these Visa and Mastercard companies. American Express is I would say, it's very different. Of course, if you know the company, then you know it's very different than Visa and Mastercard. But the thing I like about American Express is that people that use it usually are in the high credit score. People that use it are usually more in the high income side. So the subscription that they pay, not subscription, but the fee that they pay every year for having an Amex card, well, that is actually not that much for them. That when you look at American Express, it's more like, it's a business that's more like, if you think about it, Ferrari or Hermes. The meaning here is that people liked to show that they have an American Express card. It's treated as luxury, not in a way as a luxury item, but it's treated as someone with high income if someone sees a American Express card. So the company still has a moat. I think the business is going to do good, but am I looking to buy this? No, I will be buying Mastercard instead. Now, Chevron, ExxonMobil, they're the ones benefiting from Venezuela invasion. It'll be interesting to see how they perform. I'm not going to monitor them, but it will be interesting to see. So these are the companies here that I will be monitoring, like I said, but I will be going over now Microsoft, Meta, ASML. There's also one company that is not here listed, but I really, really want to buy this. So you have to wait to the end. I'm joking. You're not going to wait at the end. It's Intuitive Surgical. It's, I would say, a monopoly robotics company in the healthcare side, but I will go over this at the end. So starting with Microsoft, they have a rating of 4.17 out of 5. Their forward P is 26. Their current P is 33. I would say they're fairly valued right now. They're not overvalued, but they're fairly valued. A bit overvalued, but not at a bargain price, I would say. A bargain price maybe would have been here, 444. That could have been an okay price. Here is still an okay price, but I will not go all in at this price. I don't think so. The gross margins, as we know, is 68%. Their operating margin is 46%. Return on invested capital is 26%. The company is doing fine, but the company definitely is mature. Their revenues are not that explosive, I would say, but they're still up to right. They're steady. Microsoft is a steady company. That Microsoft 365 is very sticky. It's very, very sticky. If you think about it, companies like JB Morgan or any big company, they won't just switch to Microsoft, to Google Drive, not Google Drive, Google Docs, just because it's cheaper. The reason is that they might lose files, or it might be a tough time to transfer. They might lose some data. It's not worth it. Companies have millions of files, millions of documents. It's not worth changing everything there. But it is interesting to monitor. The thing that you should be looking at for Microsoft will be the Azure growth rate and also the AI revenue contribution. I want to see this growing, Azure Cloud. I think it needs to be growing for Microsoft. It needs to be growing. It's very important for it to keep growing. If Microsoft shows weakness in capturing the market, it will be a tough call for Microsoft. I think the stock might drop a bit, but I think they're going to do fine. Microsoft just needs to do fine. They really just need to do fine. Their productivity suite is also growing, so the business is not doing bad. I would say the personal computer revenue, I think we might see this increase from here in December. Not December, I mean the Q4 report. The reason is the more AI gets advanced, ChatGPT, LLM models, the more people would like to switch their old laptop because maybe it's not running anymore as well. Maybe it's a bit heavy, especially if someone's coding or something. So more personal computers could be bought as a switch. It's a cycle. It's always a cycle. So I think they're going to have a good quarter for personal computing, and I guess we'll see. But Microsoft is a company I am monitoring. I need to see Azure Cloud increasing, and I also need to see that Copilot is doing more workflows. They're creating more workflows. They're creating more services with Copilot. I think that would be a very, very important thing. It makes it more attractive for customers to choose Microsoft, I would say also. Adds more service. So this would be very important to watch. The risks, I would say, is the company might be slowing down because the company is already massive. But we'll see. I don't think this is going to happen. Cloud is also a big competition between AWS, Google Cloud. So I need to see Azure Cloud increasing. The next company we have is Meta. Meta Platforms, I think, is one of the amazing companies. I made a video about it, and I think it could really, really reach $4 trillion in market cap by 2030. Now, this might be a stretch, but I don't think so. The company has around 2 billion users on WhatsApp. WhatsApp monetization is just still kicking in right now. The company has AI wearables that's already out of stock. People want them. I want them. I want them myself, but they're sold out everywhere. Meta glasses is insane. I think Meta is very close in the upcoming years to have an iPhone moment, a third priority device that people would have in their pockets, on their face or whatever. They're very close to creating something like this. Meta launched Threads out of thin air, and they have more users than X. Can you believe this? Meta has more mobile users than X. Meta as in, I mean, Threads. It's pretty insane. I mean, I don't know anyone that uses Threads. Do you? I don't know anyone. I myself don't use Threads. And the reason why the stock went up recently was they announced that they're going to monetize Threads. So it looks good. I think Meta is in a tremendous space. Having 3.9 billion people on your app is insane. The amount of possibilities Meta can have, the amount of ads they can present to 3.5 billion users. Attention in this world is everything. Companies are fighting for attention. They're trying to get in front of their users. And Meta has half of the world. So you tell me, how important could that be? And how valuable is that? The company is also still founder-led. So I love companies that are founder-led, especially Mark Zuckerberg. I trust him. I trust the management. He is very bold. And he also corrects himself when he makes a mistake. Same thing we saw with the metaverse. And this is the reason why the stock fell down after the recent earnings, is because investors are scared that we might have a metaverse moment with the increased spending on capex, but I don't think so. I use Instagram every day. I use Reels every day. I use it more than TikTok right now. I see the ads. I see the AI in the Reels when it's translated videos. I see the spending and I see how valuable it is. I use WhatsApp every day. I see the WhatsApp AI summary that's in the group chat, and I think that's also valuable. So Meta is a great company. Let's go over them really quickly and cover them. I'm using physical.ai. Physical Physical.ai is a very, I would say, one of the best for stock analysis. If you are a serious investor, you want good looking charts like this here, then you should be using Physical AI. I have a 15% discount in the description below. Use it, it's cheaper. And if you want a good DCF calculation without using Excel spreadsheet, all these messy spreadsheets, then you can have stock unlock also at a discount after you subscribe, both in the description below. Check those links, they're literally cheaper. There's no reason not to get them. You can unlock 2 weeks free here, Physical.ai, with no credit card required. But let's get back to the video. Meta has total revenue CAGR of 27%, net income CAGR of 32%, free cash flow CAGR of 19%, and a return on invested capital of 25%. Let's not forget, what's the market cap? The market cap is 1.6 trillion, and they have all these growth in them. Meta is treated as still as a social media company, but I think it's much more than that. The company has tremendous ways they could collect revenue, and we can see this right here when I click on segment and I click other revenue segment. You can see how this is growing. This is insane. It's really growing fast. Other revenue segment, and I would assume the other revenue segments include things like WhatsApp monetization, AI wearables, and all these type of things. So you can see how these are catching up, but of course advertisement is still the leader here, and revenue, the other segment revenue is growing at 40% CAGR, and the advertisement is going 15% CAGR. So other side segments are, I would say, growing even, faster. They have a rate of 4 out of 5. Their gross margin is 82%, operating margin 43%, return on invested capital 26%, revenue increased by 21%. Everything looks nice. I would say the things to watch out for this report is the capex spending. We know from the last report that the company is already spending on capex. They said that they're going to spend much more. I think the price is priced in right now, the capex spending. But you never know. They might have here. I think this is the wrong chart, showing the wrong numbers. But the capex spending would be good thing to monitor. The company has also cut their spending in Reality Labs and laid off employees, so that's good for the company. They don't need to spend as much in Reality Labs, something that's not, I would say something that's not worth it right now, and they should focus more on the AI and growth and monetizing WhatsApp and these type of things. So I would check their margins, I would check their ad revenue growth, I would also check their segment revenue growth, and the risks I would say is the ad cycle. Problems with like Temu and Shein, if they are spending less on ads or not. Risks could also be heavy spending on the metaverse, but they already said they're gonna cancel these things. And regulation, privacy risks from other countries. Sometimes Meta faces lawsuits for these type of things. The next company we have on our list is Mastercard. Before I even talked about it here, Mastercard is a great business you can own, one of the quality business. I think that Mastercard really benefits in any economy, especially recessions. Recessions, that means just higher revenue for Mastercard. It's trading right now at an okay price. It's not the cheapest, but I would also say it's not the most expensive. I think it's a good position to start. Again, not financial advice. They have an operating margin of 59%, free cash flow margin 51%, revenue increase 15%. The company looks very good, I would say. It's still in a sector that is growing. It's always going to be growing, I would say. People are not going to spend less. People are going to spend more and more and more. So that means just more money for Mastercard, I would say. The net income has a CAGR of 15%, free cash flow CAGR of 15%, total revenue CAGR of 12%. Company looks pretty good. I am buying at these levels. Mastercard is a buy for me. Let's compare it to Visa quickly. So Mastercard has a bigger rate than Visa. Their margins, Visa has way better margins, I would say, but they're close. Everything looks here close. They're not too far. So yeah, they're both the same. Visa's more stable. You'll find more super investors trading Visa. It's more of a stable company, but Mastercard has more growth than Visa. So I would choose Mastercard. Both are the same. So both applies. The next company we have is ASML. ASML is one of the most important companies in the world, I would say. I think if ASML did not exist, then maybe the laptop or the mobile or the TV that you're looking at right now might not be as the most advanced. We would be still stuck in maybe 2010. But ASML is a very important company to the world. It was trading at $1,000 and then it went down to around 600, 500. So if you bought it here, that's a good thing. Then it went back up insane. It's actually insane. I mean, if you're a shareholder, then you're happy. Year to date, the company is, let's see, year to date, 21% up year to date. I made a video about this, so maybe you should have watched it. But when I made a video, I think it was trading around these levels. So it wasn't the cheapest also. A forward PE of 44, a current PE of 44. So are there more expectations, less expectations in the future? The earnings, I think, is very important for ASML because investors might have gotten too excited for ASML and maybe did not deserve this price. I think it's a great business. I think it's a very, very important business. Its revenue CAGR grew by 19%. Their net income CAGR by 23%. Their free cash flow margin grew by 27%. And they have, let's see, their margins. They have 51% margins, operating margins of 37%, return on invested capital 51%, revenue increased by 26%, 51%, and they sell physical machines. That's a good business. Let's see. I made a video about ASML 2 weeks ago. 2 weeks ago. 99 subscribers. So I'm 1 subscriber away from 100. So I made a video with 1,200. Not bad. Their PE was 39 at the time. Their forward PE was 40. So yeah, I think the company is good, but I would not be paying at this price. I would not be paying. I would rather choose TSM at this price than ASML. I think they're both important. The risks for ASML is just cyclical semiconductor demand, some geopolitical risks, but for ASML, I think it's fine. Short-term order volatility. So these are things that you should monitor, and also things like order intake you should monitor. Customer demand outlook should monitor, because if there's no demand in the future for ASML machines, then this could really also hurt other semiconductor stocks, especially like TSM or Broadcom or Nvidia. So ASML is very important. If you are an investor in Nvidia, AMD, or any other semiconductor company, then you should also follow ASML. You should see what they say, especially about their customers, how they're spending, what they're expecting in revenue, what they're expecting in demand. But ASML is a very sophisticated business. Their machines that they sell, it took them years to perfect and to get this knowledge. I mean, even though there's sometimes other competitors from China or other competitors from other places, the company's way ahead. So I'm not scared for ASML at all, even if there's competitors that are growing a bit, because at the end they're the ones that sell the best machines. They're the ones that have the best machines, and they're the ones where the companies that want to be the best are going to buy. You can say that Intel fell because they did not buy at the time. They thought they were too expensive, and Taiwan Semiconductor bought. They're fine. The company is doing fine. The company is still growing. They're still in demand. We're still very early in AI. It's a new technology. It only gets advanced from here. And I think that companies like ASML, Taiwan Semiconductor, and other AI companies and semiconductor companies are going to do well in the future. Because AI gets advanced, so there's going to be a risk on cybersecurity. And that's why I bought Fortinet. You can watch this video here. So ASML is a compounder. They still have high margins. I would want to also look at their margins, see if they're decreasing. But I think the most important thing to look for here is their outlook and what they say about their customers and what type of demand and how much are they expecting in demand. The next company that their earnings is still not here at all. It's April, but I want to buy this company very bad, but it's expensive. I can't justify the price. This company is Intuitive Surgical, and it's basically the robotics in the healthcare, and they're not a small company. They're not a small company, as you can see. Intuitive Surgical make machines like these for surgery, and no matter how the world gets or how bad the economy gets, people still need to do surgeries. So hospitals need to buy these advanced stuff. Hospitals need to save life, and they may need to make surgeries on people. So this is Intuitive Surgical. It's a very sophisticated business. I would say it's one of the best in robotics. It's one of the best that's actually changing the lives of people. I want to buy this business. It's expensive. 53 PE ratio, 65 current PE. It's expensive. If I look, they have gross margins of 66%. Again, they're selling physical products and they have a gross margin of 66%. I think my next video is going to be about Intuitive Surgical. I will make a deeper video on Intuitive Surgical. It's a monopoly in the robotic surgery play. Their operating margin is 29%. Their return on invested capital is 29% as well. Revenue increased by 20%. Yeah, but like I said, their valuation, their price to sales ratio of 18 is below their average of 18.79. Their free cash flow risk premium of 0.29. Yeah, I think they are expensive. I really cannot try to justify the price for them right now. Their service revenue is growing by 12%. Their product revenue is growing by 12% as well. So they're still growing. They're still in need, and I would say quarterly they're also still growing. So the business is not declining at all. You can see up to the right. That's what I like to see. But let's look at their net income CAGR of 15%, free cash flow CAGR of 2.9%, but revenue CAGR of 15%. But it's expensive. It's expensive. It's a very good company. It's a very good company. Their Da Vinci product is also very interesting to see. Yeah, I mean, this is a type of stock that I would want to buy at a cheaper price, around 400 or 350. But yeah, this is a stock to monitor in the future. I would love to own this company. I think it's going to do amazingly well in the future. But I need to make a video for this company. I need to make a deeper dive video. So don't forget to subscribe. Don't forget to like this video. And tell me, what stocks are you monitoring? What stocks are you monitoring for this earnings week? It's going to be a very important week. It's going to tell us the outlook of what's happening. And I think Q1 as well for these companies in the upcoming months is going to be very important. They're going to tell us the outlook of 2026 and how is it going to look like. So yeah, I will be covering these companies. If anything seems interesting of the companies I followed today, if any of the earnings reports seem more interesting, then I'll make a separate video. But Intuitive Surgical will be a video I want to make, and it's a very, very interesting company that I think people do not know much. It's a very niche company, I would say, as well. Most people are focused on other robotics company, but I think Intuitive Surgical is actually the one that's making a difference in this world, and at the same time they're actually doing what they're doing, if you know what I mean. Robotics has been seen as a place where it's going to happen in a few years. Well, Intuitive Surgical has been doing it for years. For years they have been doing this. So it would be interesting to monitor all these companies, and I wish for Intuitive Surgical in the future to go down so I can buy it. So yeah, thank you for watching this video. Don't forget to like and subscribe, and I'll see you on the next one.